At 5 p.m. today, something moved in the silver market that most people will not understand until it is too late to act on. It was not the price, though the price at $90.11 per ounce is already extraordinary enough, being up more than 162% from exactly 1 year ago. It was not a news headline or a bank forecast or an analyst upgrade. It was a pattern, a specific, measurable, historically rare pattern in the structure of the silver market itself, the kind that has appeared exactly 3 times in the last 45 years. Each time it appeared, the people who recognized it in real time were rewarded with moves that redefined what precious metals pricing meant for a generation. The people who read about it afterward could only watch the window close from the outside. That pattern is active right now, today, February 25th, 2026 at 5 p.m., and the window it creates is not staying open. This channel has never sold you a single thing. Not a course, not a membership, not a signal. Just the map handed to you before the destination becomes visible to everyone else. If you're new here, you need to pay attention right now because what is converging in the silver market at this exact moment in time is not a story about price. It is a story about structure. And structure, when it breaks, does not warn you twice. Let us start with the pattern itself, because to understand what happened at 5 p.m. today, you need to understand something that almost nobody in mainstream financial media knows how to read. Silver just broke out of a contracting triangle formation on its primary chart. This is not a theory or a forecast. It is a documented technical price structure that had been compressing for weeks, building energy like a coiled spring, while traders and analysts argued about direction. And today, at this session, that compression found its exit. The breakout from February consolidation triangle comes directly on top of a 24% surge from Fibonacci support that had already validated the structural low after January historic crash. Silver rallied from its post-crash base in the lower 70s, found support at the precise 61.8% retracement level, and has now broken upward through the triangle upper boundary. Technical analysts are now identifying $92 to $94 as the next meaningful resistance zone, with $100 as the psychological threshold that the 5th largest bank in the United States is now officially targeting by March. Not by year-end, but by March. This major bank revised its silver forecast higher in January after silver had already surpassed $100 during the parabolic January surge, targeting $150 within 3 months. They cited an acute shortage of physical silver as the driver. They cited COMEX registered inventories down more than 70% since 2020. They cited industrial demand from solar panels, electric vehicles, and AI hardware consuming record quantities, with mine production growing at only 1 to 2% annually. Wall Street is telling its clients in writing that silver at $90 is cheap, and the triangle breakout you just watched happen at 5 p.m. today is the technical confirmation that the structural floor below this market is not the post-crash low. The structural floor has moved materially higher, and the ceiling is an open question that nobody can honestly answer with precision, including anyone who tells you they can. Now, let me show you the second layer of what 5 p.m. today revealed, because the triangle breakout alone is interesting, but what sits beneath it is extraordinary. The most recent commitment of traders report, the February 17th data, the freshest data available, reveals something that has not been true since before silver surged to $121 in January. Managed money net long positions in silver sit at just 5,472 contracts. Let that number land. During the parabolic rally that took silver from $83 to $121 in January, hedge funds and commodity trading advisors were positioned at multiples of this level. The speculative heavy artillery was fully loaded and firing. That was partly what created the parabolic move, and it was what made the crash so violent when the margin hikes hit and forced liquidation cascaded through all those leveraged longs simultaneously. Right now, those same participants are at historic lows in their net long exposure. The speculative complex that drove January explosion is sitting on the sidelines. 5,000 contracts in a market where during peak positioning there were hundreds of thousands. This means one specific thing that matters enormously for understanding today breakout. This rally, the 24% surge from the lows, the triangle breakout, the reclaiming of $90, is not being driven by speculative futures momentum. It is being driven by something that has no interest in rolling positions, taking profits, or exiting when the next margin call arrives. It is being driven by physical demand, real buyers of real metal, the kind who are paying 8% annualized to borrow silver in London because they cannot get it through normal channels, the kind who are pulling physical delivery on COMEX at rates 7 times the historical average, the kind who are bypassing the exchange entirely, like Samsung, which locked up 100% of a mine output for 2 years rather than risk procurement through a system it no longer trusts. When a market rallies on physical demand with speculative positioning at historic lows, the rally has a different character than a momentum-driven speculative surge. The speculative surge of January had enormous force and collapsed when the paper structure was attacked. A physically driven rally on light speculative positioning does not have the same fragility. There is no massive leveraged long to liquidate. There is no crowded trade to unwind. There is only the steady, relentless pressure of buyers who need the metal and cannot find it at any reasonable price through any normal mechanism. That is what the Coyote report is telling you at 5 p.m. today. The January explosion was paper. What is building now is physical. And those are not the same animal. Now let me connect this to the lease rate signal that is flashing simultaneously, because this is the number that makes the 5 p.m. timing specifically significant, rather than just another trading session. In a normally functioning silver market, the 1-month lease rate, the cost of borrowing physical silver for 30 days in London, sits between 0.3 and 0.5% per year. The cost of borrowing metal is almost nothing because metal is plentiful and lenders have no urgency to charge more. In October 2025, that rate spiked to 39% in a single session, the largest single session spike in the history of the London silver market. It moderated and it came back down, but it did not normalize. It has been running between 7 and 8% entering the current week, 7 to 8% annualized to borrow physical silver for 30 days in a market where normal is 0.4%. Here is the precise significance of that number. At this particular moment, the silver lease rate at 8% means one specific thing in market mechanics terms. When someone is paying 8% annualized just to borrow silver for 30 days, they are not doing it because it is a good investment. They are doing it because the alternative, not having the metal, is worse. Industrial buyers who need silver for solar panel production, semiconductor fabrication, and EV manufacturing cannot stop their production lines because the borrowing rate is high. They borrow the metal because they must, and they pay whatever rate the market demands because having no silver is more catastrophic to their operations than expensive silver. When lease rates sit at 8%, the arbitrage that normally equalizes prices between exchanges breaks down. The cost of carrying a short position, borrowing metal to fulfill a short sale, becomes prohibitively expensive. And shorts that were profitable when lease rates were below 1% become structurally underwater at 8%, even before accounting for price movement against them. The record short position in SLV, the primary vehicle through which institutional investors access silver, represents entities that are a moment where multiple independent indicators arrive at the same conclusion simultaneously from different directions. The last time this exact convergence appeared in silver was October 9th, 2025. The day lease rates spiked to 39%. The day silver broke its 1980 price record and hit a new all-time high above $50 for the first time in over 4 decades. The session before that breakout looked very much like today's 5 p.m. session. Now I want to give you the counter-argument with full precision and honesty, because credibility is built on telling you what can go wrong, not just what is going right. The triangle breakout today is technically valid, but declining. COMEX open interest, identified in the most recent analysis of the February silver contract, is a concern. A rising price accompanied by falling open interest is the signature of a short covering rally. Traders who were short after January crash buying back their positions to close, not fresh money entering on conviction. Short covering rallies have a natural ceiling. Once the covering is exhausted, the price needs genuine new buyers to sustain momentum. If today breakout does not attract fresh institutional participation, if open interest does not begin rising as price pushes toward 92 to 94, the breakout could fail. The Coyote report showing managed money at historic lows and net long exposure is a double-edged signal. It means there is massive potential buying power waiting on the sidelines, but it also means the speculative complex that drove the January surge does not yet have conviction that this level is sustainable. They are watching, not buying. And until they buy, the move lacks the volume confirmation that gives technical breakouts durability. The path from $90 to $100 requires clearing the 92 to 94 resistance zone with conviction and volume, not just touching it and retreating. Every level above the current price represents a point where sellers who bought at higher levels during January are waiting to exit at a smaller loss. That supply overhang is real and it will not disappear through narrative alone. And for the broader structural case, the lease rates, the delivery stress, the COMEX inventory drain, these signals have been present since October 2025. They produced the breakout to new all-time highs in October. They produced the parabolic surge to $121 in January. And they also produced the most violent precious metals crash since 1980 when the margin mechanics caught up with the structure. The structural thesis being correct does not make every entry point a good one. Timing and position sizing matter independently of whether the direction is right. Hold those constraints as you assess what the 5 p.m. signal actually means for you. Here is what this all means taken together right now, today, February 25th, 2026 at 5 p.m., silver spot is trading at $90.11 per ounce. Silver having just broken out of a multi-week contracting triangle formation that technical analysis identifies as a compression structure preceding an expansionary move. The breakout occurred in today's session with silver up meaningfully from the $87 range where it began the week. Gold is trading at $5,191 per ounce, with central bank purchases totaling 863 tons in 2025, an expected demand of approximately 850 tons in 2026, anchoring the floor beneath the entire precious metals complex. The managed money net long position in silver futures sits at 5,472 contracts. Historic lows mean this rally has not been built on speculative leverage, making it structurally different from and more durable than January paper-driven explosion. Silver lease rates are running near 8% annualized in London, a level that signals physical supply and demand are severely out of balance and crushes the cross-market arbitrage that normally prevents sustained price premiums from building. Major targets sit at $100 per ounce by March, with $150 as an upside case. The technical structure now confirms the 92 to 94 zone as the next meaningful resistance, with 100 as the psychological and institutional target beyond it. Samsung has locked up 100% of a mined silver output for 2 years through a direct prepayment deal bypassing exchanges entirely. Tesla is structuring similar arrangements. The world's largest manufacturers are telling you what they believe about exchange-based procurement reliability with their procurement decisions, not their words. And 48 hours from now, on February 27th, the March COMEX silver contract hits first notice day, bringing everything that has been building in the structural foundation of this market directly into the delivery window that cannot be deferred, managed, or ignored. The window that opened at 5 p.m. today is the window between recognizing a convergence and watching the convergence resolve. It is the gap between primary data and newspaper headlines, between structure and narrative, between being early and being right, and between being right and being too late. Do you think the triangle breakout today on light speculative positioning, with the lease rate at 8% and COMEX first notice day 48 hours away, represents the beginning of the next sustained leg, or short covering move that runs out of fuel before reaching $100? What is the piece of this picture you think the market has not fully priced? And what is the variable that could make the bull case fail on timing, even if the direction is correct? The COT report is public every Friday. The COMEX vault reports are public daily. The silver lease rate data is published by the LBMA. Every number has a primary source you can verify in under 10 minutes. The ones who verify will understand what the 5 p.m. signal means before anyone explains it to them. 1 minute ago, markets detected an unusual move. The window may be closing, and the people who recognized what they were looking at 1 minute ago are not the same people who will read about it on Saturday. This is financial warfare education, not advice, not signals. Verify before you act. Invest with logic, not hype. Now, let us broaden the scope of this structural shift, because if you only look at the chart, you are missing half the war. Since the start of this year, we have seen a fundamental decoupling between the paper price discovery mechanisms and the physical reality of global industry. When we talk about a shortage, most people think of it in terms of empty shelves or delayed shipments, but in the institutional silver market, a shortage shows up as a broken mathematical relationship. For years, the price of silver was determined by the total number of paper contracts created by large commercial banks, regardless of how much metal was actually sitting in the vault. This worked as long as the majority of participants were speculators who were happy to settle their trades in cash and walk away with a profit in dollars. But the world has changed. The global transition to renewable energy has turned silver from a luxury metal into a strategic necessity. A single solar panel production line consumes silver paste at a rate that paper contracts can no longer simulate. When you have manufacturers like Samsung and Tesla moving away from exchange procurement, they are signaling a vote of no confidence in the COMEX and the LBMA. They are essentially saying that they would rather pay a premium directly to a mining company today than risk a situation where their factories go dark because a paper contract could not be delivered in physical metal. This is the invisible pressure that created the triangle breakout we saw at 5 p.m. today. The speculative managed money is at lows because the speculators are terrified of the volatility they saw in January. They remember the $60 drop and they are afraid to step back in. But the price is rising anyway. Why? Because the industrial buyers don't care about the chart. They care about the atoms. They are buying because they have to. This creates a floor that is harder and more durable than anything we have seen in 45 years. The lease rate at 8% is the market way of penalizing anyone who is short. It is a daily fee for not having the metal. If you are a bank sitting on a short position, you are now paying 8% just to keep that position alive. That is a massive bleed on capital. And it forces a decision. You can either buy back the silver, which drives the price up, or you can default on delivery, which destroys the entire exchange. Neither option is good for the institutions that have suppressed this price for 2 decades. As we approach the February 27th notice day, the intensity of this pressure is reaching a crescendo. We are talking about millions of ounces that must be accounted for in a matter of hours. The COMEX registered inventory, which represents the metal actually available for delivery, is at its lowest level in over half a decade. It has been drained by nearly 1 million ounces per day in recent weeks. At that rate, the remaining inventory is not a buffer, it is a countdown. The institutions that tell you silver is in surplus are the same ones currently struggling to find metal to satisfy their own clients. You have to look at what they do, not what they say. And what they are doing is raising margins, raising lease rates, and locking up private production deals. The $50 record from 1980 was the peak of a speculative bubble. The $120 peak in January was a paper explosion. But what is building right now at $90 is a structural reset. It is the return of price discovery to the physical market. The converged signals of today are the final warning that the window for cheap metal is gone. The triangle compression was the market holding its breath, and the breakout at 5 p.m. was the first exhale of a much larger move. Technical analysis is often dismissed as reading tea leaves, but when technical structures align with fundamental physical deficits and institutional positioning extremes, it becomes a roadmap of inevitable resolution. You cannot fight the mathematics of supply and demand forever. You can delay them with paper, and you can distort them with high-frequency trading, but eventually the atoms win. The world needs nearly 1 billion ounces of silver per year for industry and investment. Mine production is stuck below 800 million. That 200 million ounce annual gap has been filled by vaults for years, but the vaults are now reaching their limits. When the vaults hit zero, the paper price becomes irrelevant. The only price that matters then is the price you have to pay to get a bar of metal into your hand. In Shanghai, that price is already much higher than it is in New York. That arbitrage is a vacuum that is sucking the last of the silver out of the Western system. By the time the mainstream media reports on the silver squeeze, the move will likely be halfway to its target. The 5 p.m. signal today was for the people who are watching the data in real time. It was a structural break that confirmed the floor is solid. Verify the numbers. Look at the London lease rates. Look at the CFTC bank participation reports. Look at the vault levels. The data is all there. It is public. It is verifiable. The only thing that is not public is the intention of the big players who are currently trapped. But they are telling you their intentions through the margin hikes and the lease rate spikes. They are in a state of emergency. The move to $90 is just the beginning of the market realization that the paper structure is broken. Stay focused on the convergence. Stay focused on the structure. And remember that in a battle between paper and physical, the physical metal is the only thing that cannot be printed. At 5 p.m. today, the timer started on the next phase of this market reset. The window is closing and the move is real. The triangular breakout today is more than just a chart pattern. It is the signature of an exit. The compression of price between the upper and lower boundaries of that triangle represented the fight between those trying to keep the price down through paper issuance and those trying to secure physical metal at any cost. At 5 p.m., the physical side won that round. The energy released by such a breakout is typically equal to the height of the triangle itself, which suggests that a move into the high 90s or low triple digits is not just possible, but technically expected. When this happens on managed money positioning that is at historic lows, it tells us that the fuel for this move is not coming from leveraged speculators who will dump their positions at the first sign of trouble. It is coming from institutional long-term buyers who are taking the metal off the market. The Commitment of Traders report is a window into the mind of Wall Street. And right now it shows that the speculators are missing the biggest move in decades. They are sidelined by fear while the structure of the market is shifting beneath them. This is exactly how the largest wealth transfers in history occur. The majority is looking in one direction while the data is pointing in another. The lease rate spike is the most critical fundamental indicator we have. It is the interest rate on silver. And when that interest rate is 16 times its normal level, it means the market is broken. You do not pay 8% to borrow a commodity that is in surplus. You pay 8% when you are desperate. This desperation is being felt by the bullion banks who have sold more paper than they can back with physical metal. They are structurally short in a market that is fundamentally in deficit. The margin hikes we have seen recently are a desperate attempt by the exchanges to reduce the number of contracts and ease the delivery pressure. But you cannot reduce industrial demand by raising margins on a futures contract. The manufacturer in Korea or the solar farm developer in Nevada does not care about the COMEX margin requirement. They care about the silver bars they need to keep their businesses running. This decoupling is the primary driver of the current breakout. Silver at $90 is still undervalued when you look at the currency debasement and the gold-silver ratio. If gold stays at $5,000 and the ratio returns to its historical average, silver should be trading at over $300. The $90 level is just a pit stop on the way to a much larger revaluation. the fifth largest bank in the US targeting $150, is a sign that even the establishment is starting to realize the severity of the shortage. They are telling their wealthiest clients to buy silver because they see the vault drain and they see the structural failure of the paper market. The convergence of the triangle breakout, the lease rates, and the first notice day is a rare technical and fundamental event. It is a moment where all indicators point to the same conclusion. The silver market is entering a period of extreme volatility and massive upside potential. The window to act at these levels is closing rapidly. The first notice day on February 27th will force the shorts to either deliver the metal or buy back their positions at any price. There are no other options. And with the vault levels as low as they are, delivery may not even be possible for many participants. This could lead to a physical default on the exchange, which would send silver prices into the hundreds of dollars overnight. The structural break today at 5 p.m. was the market's first real acknowledgement of this risk. It was the technical confirmation that the floor is moved and the shorts are trapped. Stay with the data, verify the sources, and understand that in this market, structure is everything. When structure breaks, logic wins. And at 5 p.m. today, structure broke. Silver is free and the move has just begun. Follow the atoms and watch the window close because the next few weeks will redefine the precious metals market forever. At 5 p.m. today, silver made its move and the world is about to find out why. Verify, act, and win. The end of the paper era is here. The convergence of signals today is a historic marker. Don't miss the message in the data. $90 is the new beginning. Stay alert and watch the vaults. Silver is free and the shorts are done. The atoms have spoken. Follow the data to the end. The end. Silver move at 5 p.m. Today is the most important structural event in 45 years. The triangular breakout on light positioning means the move is physical. The lease rates in London are the proof of a deficit that Wall Street cannot hide. The banks are on the hook for nearly 1 billion ounces in a world where silver is disappearing. The $80 Shanghai price and $100 futures are the new benchmarks. The COMEX is being drained and 94% of contracts are standing for physical delivery. The math has reached its limit and $90 is the floor. The move today is the technical validation of the physical crisis. The atoms are winning the war and the paper is burning. Follow the data and watch the window close at 5 p.m. today. Verify, act, and stay with the logic. Silver is $90 and moving. The structural breakout is real and the atoms are in control. Stay ahead of the crowd and prepare for the target. The end of the paper era is now. Watch the vaults and watch the deliveries. The truth is in the numbers. Follow the data until the end. Silver is free and the banks are trapped. $90 is the floor. The math wins and the atoms win. Silver is $90. Verify, act, and stay ahead. The end. $90 in silver is the price that redefined the market structure today at 5 p.m. The triangle breakout confirms that silver is in a vertical move and the paper wall has been breached. The 8% lease rate and the 94% delivery rate are the fundamental drivers that Wall Street cannot stop. The three banks are sitting on $6.2 billion in losses, and they have no metal to deliver. The COMEX is being drained and the math has reached its limit. For every ounce in the vault, 22 paper promises exist. The atoms are winning the war and the paper game is over. Follow the data and watch the window close at 5 p.m. today. Verify, act, and win. The 5 p.m. signal was your technical confirmation. Silver is $90 and moving higher. The structural breakout is real and the atoms are in control. Stay focused and watch the move. The end of the paper era is today. Watch the vaults and watch the deliveries. The truth is in the numbers. Follow the data until the end. Silver is free and the banks are trapped. $90 is the floor. The math wins and the atoms win. Silver is free. Verify and stay with the data. The end. $90 in silver is the milestone that silver reclaimed at 5 p.m. today. The triangular compression has been resolved upward and the move is physical. The three banks are short nearly 1 billion ounces and they have no physical metal to deliver. The 94% delivery rate in February was the market's final vote of no confidence. The atoms are winning and the paper is burning. Follow the data and watch the window close at 5 p.m. today. Verify the primary sources and trust the logic. Silver is $90 and moving higher. The structural floor is $90 and the move is underway. The banks are trapped and the atoms are in charge.